The first atomic bomb was dropped on Hiroshima.
Over humanity!
The fires of frustration and discord are burning in every
Let us
city.
not forget for a moment the toils and efforts that lie ahead.
They say that those who forget their history are condemned to repeat it. This is the History Lessons Podcast with certified financial planning practitioner Patrick Huey, author of History Lessons for the Modern Investor, and your guide to financial wisdom in the past, present, and future. You ready? Good. Let's get historical.
Hey, I'm Patrick Huey, author of History Lessons for the Modern Investor, and this is how history can help inform your investments, retirement, and tax planning for the week of December 8th, 2025. Today, we're focusing on going digital. And that's because on December 10th, 1972, Pong hits the arcade. And suddenly, everybody wants in. On that day in a nondescript wooden cabinet in Andy Capp's Tavern in Sunnyvale, California, that cabinet flickered to life. And inside it was Pong, the brainchild of Atari co-founder Nolan Bushnell and engineer Al Alcorn. Originally intended as a simple training exercise for Alcorn, Pong wasn't even expected to be a commercial hit by its creators. But the moment patrons saw those bouncing pixels, the game cabinet jammed with quarters faster than anyone had imagined. Within days, lines wrapped around the block. And by the end of the year, Pong machines were spreading like wildfire, from bar rooms to bowling alleys, signaling the dawn of video games as a mass market phenomenon. Pong was a symphony of simplicity: 2 paddles, a dot, and a score. But it also kicked off a new gold rush of imitators, fierce competition, and the very idea that a new kind of digital entertainment could disrupt the established order. In the aftermath, consumer behavior, business models, and investor expectations all began to shift. What looked like a novelty one quarter could become an empire by the next. The Pong craze wasn't just about gameplay. It was an early lesson in how even modest innovations can trigger manias, fuel FOMO, and tempt individuals to reimagine what's worth their next wager. Here are 4 lessons for the modern investor looking for lasting wins and fewer rookie mistakes. Lesson 1, don't chase fads. Build a game plan for the long haul. Pong's drop-dead simplicity was exciting in a way, but arcade history is littered with failed copycats and those who thought every hot new game would be the next big thing. Investors fall into the same trap, chasing hyped up stocks, funds, or asset classes only to watch them fizzle. A disciplined retirement or investment plan, one that measures progress, not just headlines, beats these all-in moments. Remember, the flavor of the month rarely fills out your nest egg. Lesson 2, simple but balanced portfolios beat complexity for most of us. Pong worked because anyone could play right away, and I mean anyone. Overwrought investment strategies with dozens of moving parts can raise costs, taxes, and headaches without necessarily improving results. A simple, broadly diversified portfolio, think individual stocks, index funds, proper asset allocation, that sort of boring stuff, that often delivers better after-tax, after-fee outcomes. The more hoops and hurdles, the more mistakes and penalties you risk, especially when withdrawals begin in retirement. Lesson 3, avoid lifestyle creep or score inflation. As Pong's popularity grew, so did the temptation to keep pumping quarters for a new high score. Investors often mirror this by adjusting their lifestyle up with every market rally, or by falling for bigger, flashier, faster investments just because accounts look flush. For retirement to last, it's crucial to keep spending and withdrawal rates aligned with real, sustainable returns, not necessarily last year's bull run. Scorekeeping is fun, but the winner's the one who stays in the game, not the one who bets it all on the next serve. And finally, tax efficiency. Don't let Uncle Sam drain your high score. Games are fun. Taxes, not so much. Poor investment location, unnecessary trading, or missing opportunities for things like Roth conversions and tax loss harvesting can erode your gains over decades. Just as Pong required watching the entire screen and not just your paddle, savvy investors look beyond their own returns to think about what they actually get to keep after taxes. Keep it efficient. Use your available tax paddles to block those unnecessary losses, and review your plan each year as rules, brackets, and your income change. Here's my final thought on the Pong era. It reminds us that in markets and in life, it pays to keep your plan easy to follow. Simplicity is key. But you also want your strategy to be sustainable and your perspective to be firmly set on the long game, not just the next hot hand.